We have 3 videos today for the price of 1. Yes, we're going to look at 3 different clips I think you vitally need to hear. When I look out over the distance of our markets, looking at just the S&P 500 as an easy barometer, nothing bad is priced into our markets. We are priced for picture perfect perfection. Now, I'm actually in the camp of we're probably going to be okay. We're probably going to have a soft landing, but the risks are too high, especially considering the CPI report that we got today, to ignore that. And some of these clips, 2 of them in particular, are outright potentially scary. One of them implies we could have a depression, like something really, really terrible. And another one implies that maybe Q2, Q3, the consumer is going to be in a really rough spot after they run through that sweet, sweet tax money that I know you and me just don't get because we're probably higher net worth individuals and own stocks. So we're going to get into all of this information. I'm going to share these clips with you, provide commentary, and make it all make sense. At the end of this video, I will go over exactly what my game plan is for this market. I think there's a very easy way to navigate this market right now to come out on top. And I'll share that with you at the end of this video. Let's get into it. Hit the like button, subscribe to the channel, all that good stuff. And again, keep in mind, I don't think this video is going to be well liked. I think a lot of people are way too bullish right now, even though I'm pretty bullish. They're bullish in the wrong sectors, the wrong areas of the markets. You want to buy low, sell high? Everyone right now is buying high and might end up selling low. So I don't expect you guys to love this video. I don't expect a lot of people to watch this video, but thank you guys for those of you guys that do, and let's get into it. Before we get into those clips, though, I do want to give you a little bit of bad news in regards to self-driving efforts. Not with Tesla, but with Waymo. Waymo issues a voluntary recall on its self-driving vehicle software. Any competitor to Tesla, Waymo or Cruise, that falls on hard times in their self-driving efforts, just to put it simply, is not good for Tesla. Right. On a regulatory front, that's for sure not good for Tesla. Now, they announced a voluntary recall on its self-driving software following 2 incidents involving its vehicles in Phoenix, Arizona. This marks the first recall by the Alphabet-owned self-driving car company. Waymo said it updated the software to better predict the future motion of a towed vehicle. Now, Tesla's stock here in after hours was positive. Now you're slightly negative. I don't know how much of an impact this will actually have to Tesla stock because it's not directly tied to FSD in one way or another, but it's still a setback for overall autonomous vehicles. Now, the first clip that we have for you is headlined, "The CPI report came back to bite the Fed," says DoubleLine CEO Jeffrey Gunlock. But the actual scary part here has very little to do with the actual CPI report and more so about this overall theme of interest rates that we're seeing. This kind of goes in direct correlation or relation to what Jamie Dimon just said a couple of weeks ago that really had me take notice, because let's be honest, if anyone knows anything out there about anything, it's Jamie Dimon, JP Morgan's longtime CEO. He's been the CEO since before the great financial crisis. He is probably one of the most connected individuals in the world, in the finance world, that is. I mean, I would argue he's up there with Jerome Powell. He's up there with, the administration, the president, the White House, whatever you want to call it. He's connected. Okay, if there's a problem, Jamie Dimon knows about it. Okay, and I just want to say before we get into these clips, I feel like I have to make this video, not even necessarily because I want to, because everyone is so bullish, and there is good reason to be bullish, but everyone's so bullish that the risks out there are definitely being clouded right now. And I don't want anyone caught off guards by any of this information. So let's jump into the first clip. And again, I will give commentary as we go. And this clip's 6 minutes long. We're not going to listen to the whole thing, but just the most important parts.
Jeffrey Gunlock, DoubleLine, of course, who joins us exclusively now.
And by the way, Jeffrey Gunlock is someone that I highly respect. He sticks to his guns, very knowledgeable individual, and overall provides great commentary. So let's give it a listen.
On Closing Bell from the ETF Exchange Conference in Miami with our very own Bob Pisani. And Bob, what a day to have Jeffrey Gunlock with us today. Take it away.
And Scotty, it is a big day, of course. Jeff joins us here speaking, of course, at the ETF Exchange Conference. Jeff, you just addressed 1,000 people in the audience. Your basic message today, interest rates have bottomed. I want to talk about CPI, but get to that message right now. Interest rates have bottomed. What's the implications for that for investors?
Well, interest rates have very long cycles historically. For whatever reason, they tend to move in a broad trend for about 40 years. And we all know that interest rates kind of rolled over at very high levels a little over 40 years ago. And now interest rates are up over the last couple of years. So it's almost exactly 40 years. And I just think that interest rates were absurdly low, particularly real interest rates. And now real interest rates are reasonable. But I think that we have a problem with the amount of money we need to borrow. And that will cause a strain.
That's the important part. It's about borrowing and the federal government spending habits. And he's going to elaborate on this, and I will as well. And Jamie Dimon, what he said a couple weeks ago is exactly that. But take a listen. This will make a lot of sense.
Strange movement that we're all used to thinking that the economy gets soft and interest rates are taken way down by the Fed, and long-term interest rates also go down by a couple hundred basis points at least. But I got a feeling that when the economy weakens enough so that the Fed really does cut in earnest, I think we're going to be having a real big problem with people understanding how much debt expense we have. And they might start thinking that longer term interest rates need to be at, well, they were 10% real yields in 1984. So it's not at all implausible that interest rates could go up into the high single digits, and it's part of this long-term trend. Now, one thing I think that...
Wow. If you did not catch that, oh my gosh. That's not just bad for the stock market. That's bad for America if that happens. He's essentially saying that based on the borrowing of the government, when the Fed cuts rates, normally there's a correlation. If the Fed is cutting rates, usually 10, 20, 30-year treasuries are going to fall with it, even though 10, 20 years, 30 years down the line, who knows where policy is going to be. So there's more uncertainty the longer the duration of the bonds. So in theory, in a perfectly perfect world, when the Fed cuts rates, it should affect the short end of the curve a lot more than the long end. And that is how it works. But the long end, he's saying, does come down. It just does, right? He's saying that when the Fed cuts rates, the world might look at the US and say, you're more risky. You're going to continue borrowing more debt. You're going to continue to put selling pressure on bonds and drive yields upwards into the mid single digits, high single digits, saying we could break above 4 to 5% interest rates as potentially the economy is weakening and the Fed is cutting rates. Holy moly. Oh my gosh. If that were to happen, the depressioners, if you will, the people that are calling for some kind of depression, well, would probably actually be right in this scenario.
The economy is more vulnerable under a rising interest rate regime than it is under a falling interest rate regime. Under a falling interest rate regime, companies that are in trouble and maybe marginal credits, even though they might have to pay more on a spread basis, they're paying lower interest rates. So they can refinance and take money out and reduce their interest expense. That prevents defaults. That supports all of the risk assets. They're reliant upon financing of marginal companies. But when interest rates are rising, maybe they'll have to default. So maybe it adds volatility to the economic cycle. And certainly that was the case when interest rates were rising in the 70s and 80s. There was tremendous economic volatility. So I think interest rate volatility and higher interest rates as a theme create more vulnerable markets.
Yeah, Scott was mentioning it's a big day.
So that's the big message out of this video. And again, he brings up a good point. In the 70s and the 80s, I mean, rates were high on 10-year treasuries. We still have never even come close to revisiting, 10+% on a 10-year treasury. Why was that happening? Well, of course, inflation, right? And the Fed's policy, but also part of it was not a great appetite to buy US treasuries. Treasuries work like a dividend stock. So if you guys don't know, when, let's say, for instance, the government is raising a bunch of money, they're selling bonds, they're collecting money. When they sell those bonds, it's like a dividend stock. If everyone wants to sell a dividend stock all of a sudden, the company doesn't cut their dividend, it stays the same. The price of the stock gets cheaper, so the yield rises. Well, he's basically saying if the world stops buying our bonds, even just marginally, 20% less buying of our bonds, 30%, 40%, which that would be quite high, that would be quite extreme. I mean, that's a problem, because no longer would you have buying pressure coming in, but you would just have a huge selling pressure from the government and not enough buying pressure to offset that, meaning yields would go higher on the long duration, and the Fed might not be able to control it. The Fed could then go out and do quantitative easing, which ultimately would probably be a positive, but initially, yeah, you could be in a pretty ugly scenario for the broader US economy. And I found what he said particularly noteworthy because of what Jamie Dimon just said on January 30th, 2024, literally like 2 weeks ago, almost to the day. Jamie Dimon says mounting US debt will eventually spark a, quote, rebellion in markets around the world. JP Morgan's CEO said that's because 7.6 trillion of US government debt is held by foreign entities in countries like Japan and China. Quote, it is a cliff. We see the cliff. Now, I also want to bring something up as well. If the Fed does start to lower rates and there's not as much of this kind of floor with 10-year treasuries, if the Fed starts to cut rates, it doesn't necessarily mean that 10-year treasury yields are going to fall. And that's what your borrowing, is done on in the real world. If you get a 7-year auto loan, well, what's the comparable to that? It's the 10-year treasury, right? When you go out and get a house, what do lenders do? They add about 3% onto the 10-year treasury. So if 10-year treasuries are 1%, well, boom, then you can get a 4% mortgage. That's like 2019 when I got my first house. 4%, I think I got 4.25%, and I bought in January when treasuries had spiked. So take that, into consideration as well, that there could be a big problem on our hands, and everyone sees it besides investors right now and the government, apparently. Now, I don't know when this will happen. It could not happen, but I think the risk is too high not to know about it. That's kind of why I feel obligated to make this video. Now, this clip is one that I also found very informative. This individual seems like he understands the marketplace a lot better than a lot of people right now. And I think what he said is very notable. And again, is something the markets are not even considering right now, but it's flying right in our face. It's not like you don't know about what he's going to talk about, but putting it into context with, what we're seeing currently, like taxes are about to come out. He's saying by Q2, really the start of Q3, the U.S. economy could be in a worse spot than a lot of people think. And I mean, we'll see, but we'll run the clip. It says liquidity is pulling back from the demo who needs it most. And this is from the current CEO, like the company.
Stuart Sopp is the CEO of Current. Stuart, great to have you with us.
Thanks for having me.
Always good to get your insight, particularly into this demographic. I read the notes and it said that you don't think that the Fed is going to allow a lot of bankruptcies, a lot of delinquencies.
And this company, Current, does a lot of what like Chime will do. If you know anyone that uses Chime, like give you your paycheck a little earlier, take a little bit of a cut from that. Now, a lot of you guys might not use Chime. You might not know anyone that uses something like a Chime or, kind of like a cash advance, but you just get your check, a couple days before or whatnot. This company services the lower demographics of the US. And really, I mean, those are the individuals that are in a little bit of a problem right now, but they are vitally important for the economy. Just think about the global financial crisis. What? 10% of mortgages failed and the whole system came collapsing down. It was a crisis, right? Same thing here. If those lower demographics are not able to push through here, then it could be a problem for everyone.
Is amongst this cohort. So do you think that there's a backstop in place that they will step in and cut before it gets too late?
Yeah, that's a good question. I think the inflation wasn't any surprise to us at Current because car insurance, renting, food price inflation, all these things that are essential goods and services to the everyday Americans were basically going up and never really went down that much. So the blend is much higher. And also we saw the spend increase. On top of that, we have amazing job growth, which we saw in the January report. When you look at that combined with the food price inflation and the car insurance at 20%, it's very obvious to us that inflation was going to be a lot higher this time.
Stu, we're digesting a bunch of like fast food earnings over the last couple of weeks, and inflation was a key theme throughout that. And so, I kind of remember you saying once to us is not only are your customers consumers at like a McDonald's, but they also work there,
That's right?
So what are some of like the leading indicators? Like we're always trying to kind of figure out how this moves its way to another demo. What are some of the things? It starts with food. Is it gas? What are some of the things we should have our eyes open for over the next few months?
So at Current, obviously, we're focused on a everyday American subprime, sub 620 FICO score, if that makes sense. Average HHI is like 45K. So not only do they consume Starbucks, McDonald's, and work at Walmart and consume at Walmart, they also work there. And so you should be looking at those earning reports last week, and you were starting to see telltale signs of some of those things happening. But I think more broadly, you're seeing a deterioration in potentially credit quality. Look at I would draw your attention to credit cards and their delinquencies. Look at the subprime, 16% delinquency rates, 4 times that of the superprime. You look at credit card debt overall is 54% year-on-year higher. So at the moment, we're seeing the consumer and their journey from Christmas all the way to January into February, filling that gap with credit that they don't necessarily afford.
Credit card debt, the average rate, I think, is 21.47% now, 1.13 trillion. Consumer debt in aggregate's now north of 17.5 trillion. How does that play into your demographic with all the moves in interest rates that we're seeing?
Yeah, so going back to Melissa's point of the first time, I think the Fed has like 3 things they can play here.
This I found very fascinating. Take a listen to the 3 things the Fed can do here.
First is pop the AI bubble, which I think we can all agree that's probably a bubble. 2 is commercial real estate that's stacked in regional banks. So that's one thing that may or may not play out. And 3rd is the U.S. consumer. And do they want to play that game? So what I mean by that is a deterioration into Q2. Right now, what we're seeing is tax refunds. They're all waiting for these tax refunds to hit over the next week. The IRS has been delayed a week. And so you're seeing the everyday consumer right now wait for that money. And what they'll do is they'll start spending down and paying down their auto loans, which is something you should be looking at, and their credit card debt, which is the thing I want to draw attention to because there's a missed product market fit for the consumer and what's being offered. I think then you look March into April. April's going to be the time when the U.S. consumer, if they don't pop one of those other 2 bubbles, the U.S. consumer may be in trouble in Q2.
Wow. Yeah. That's a bit of a problem because that's he's saying kind of exactly what we've been seeing, right? Credit card default rates have been off the charts recently, especially around Christmas time, the data that we just got. Look at Discover, Capital One, American Express. They service a little bit higher of a net worth demographic, but especially Discover, Capital One, your lower tier credit card companies, if you will, they reported some pretty bad numbers, needing to bring more liquidity to the table because a lot of their loans they don't expect to ever get paid back. People just spent like crazy on the credit cards, and it makes sense around tax time, right? People are going to, pay some of that off. People are going to spend out there, but a lot of that's just going to be catching up from what they already spent. I mean, not to mention if they don't even pay their credit cards and just continue to spend. I mean, that's obviously a bigger problem there. But by Q2, Q3, the consumer could be in a really weak place. Now, this has potential positive implications for the Fed. That could mean the Fed maybe, does ultimately have leeway to start cutting rates. But this is vitally important, what I'm going to say next. The markets always will care more about the economy than whether the Fed funds rate is 5% or 0%, right? If the economy sucks, if you're in a recession or going into one, it doesn't matter what the Fed does, stocks will not do well. That's why typically stocks sell off about 25% following the first Fed rate cut. Usually it's because of a weak economy, right? And actually during a Fed hiking cycle, most of the time stocks do very well. That's why 2022 is such a strange year, because normally when the Fed raises rates, stocks do well. I mean, look at 05 through 07. When the Fed raised rates from like 1% to 5.25% and held them there for 18 months. From 05 to 08 was a very good time to be an investor, right? You understand, right? This was a great time to be an investor. Even in like, after that a little bit, like 2015 to 2019, when the Fed was incrementally raising rates very, very slowly, that was a great time to be in the markets. But I mean, 2022 is not. But then when you get the first rate cut, it tends to be negative. The Fed might just, push it too far here. And the consumer's already not in a great place. But I found it interesting that he said you could pop the AI bubble and that would kind of do the same thing and forcing the Fed to move a little quicker and actually cutting rates. Now, that's actually pretty interesting that he brought that up. Now, Apotheus on X, thank you for tagging me in this. He shares this from Gary Gensler, and he's the chair of the SEC, the top guy in the Securities and Exchange Commission. He says, beware of misleading AI hype and AI washing. He says that misleading AI hype is essentially what's happening right now. And the way Gary Gensler said this, he said this in a way of warning, quote, warning companies about AI washing when they talk to investors about their use of the technology. So trying to basically talk up AI and what it will do for, specific companies. Found that pretty interesting. I think a lot of whether or not we pop the AI bubble really comes down to NVIDIA earnings on February 21st. What that looks like, specifically what's going on in China. Are they going to start shipping, more chips over there? Does China even want their chips? And what does the demand look like from here? I mean, it looks pretty good, but it becomes harder and harder to grow 20, 30, 40% on a year-over-year basis when you're getting into $20-30 billion of revenue every 3 months, every quarter. And that's what NVIDIA is expected to do, around $20.2 billion. Do they give you another huge guide up? That's something the markets need to see at this point to keep the AI really bubble alive. Now, the third clip, I actually only watched like the first 2 minutes of this, so some of this might be new to me as well. It says the Fed will leave rates elevated, which will cause a shallow recession. So I want to give this a little bit of a play. And then actually the last clip that we'll look at is kind of bullish for Tesla and small cap stocks, believe that or not.
Joining us to discuss this morning, Northwestern Mutual Wealth Management CIO Brent Schutte. Brent, it's great to have you. We've seen a lot of folks peel off their recession calls for the year, but you're being a bit stubborn on this one. Talk about why.
Yeah, so we did have a forecast that inflation would move lower in 2023, and so we were optimistic on inflation when others were pessimistic because we believed that was tied to COVID. Unfortunately, what you're seeing now is that inflation is tied to the business cycle. So think about wages being above 4%, well above 4%. Think about companies continuing to raise prices. I think you're seeing that today. You've seen all these different measures of CPI actually move higher. For example, in the Cleveland Fed, median CPI is running at a 6% 1 month annualized pace. Core sticky CPI running at 6%. And so to me, what's going to happen is the Fed's going to leave rates elevated. The longer they leave rates elevated, the more it works its way into the economy. And that will eventually cause the consumer and corporations to have some weakness, which will lead to that short, shallow recession that we believe is on the horizon.
Lael Brainerd from the National Economic Council just told us don't pay too much attention to one number. And the broader trend is that we're seeing good growth and inflation come down without disrupting the labor market.
I'm not for sure. I mean, if you look at different measures of CPI, so for example, I mentioned the Cleveland Fed median CPI, which they believe provides a better view of the underlying trend of inflation. It bottomed in July at around 2% on a 1-month annualized basis. It's pretty much gone up every month to now being over 6%. That is not an underlying trend of inflation that's crumbling. Core services, which is tied to wages, has actually been rising for some time. It's in the 6% on a 3 and 6 month annualized basis. And so, yes, goods inflation has come down, but other measures of inflation that are more tied to the business cycle are not. And that's where the big issue is to me. I mean, wages running at 4.5% to 4.8% is not consistent with sustainable 2% inflation. It's more consistent with the end of a business cycle, which is where, unfortunately, I think we're at.
Says we're at the end of a business cycle. That's a good way of saying things are about as good as they're going to get here, and we probably enter into a recession. Now, he believes this will be a short and shallow recession. I think that goes back to what Jeffrey Gunlock said and what actually happens with rates. Keep in mind, again, I will stress this to you because whether or not Jeffrey Gunlock is correct or not really comes down to this. What you pay for a car loan, what you pay for a home loan, what you pay for a business loan, or any other kind of loan out there, it's not the federal funds rate, okay? It's just not. The federal funds rate is the rate in which banks lend to each other. Like, hey, JP Morgan, I know you're loaded over there and have deep pockets. You just bought First Republic. I'm CEO of whatever, Citibank. I need $1 billion overnight to cover this charge. I'll get it back to you. And that's how it goes, right? It's 5.5%. That's the rate. Now, on a day-by-day basis, it's obviously going to not be way less than that because 5% would be like a yearly rate. But that is essentially what the Fed funds rate is, or not just bank-to-bank lending, but Fed-to-bank lending, right? That's what the Fed funds rate is. It only affects treasuries. So whether or not we have a soft landing or a hard landing or a shallow recession, whatever wordage you want to put there, is essentially dictated towards what does the government do with selling treasuries? Do they stop selling treasuries as much as they were? And does the world continue to buy U.S. treasuries? When the Fed funds rate drops, there's going to be less support for treasury yields, right? And in theory, the government, raising more cash, selling more bonds, supply and demand should drive yields higher. And I think that's something to be watching for very closely in the coming months. And even after today, 10-year treasury yields are now almost 4.5% again. That is putting the real pressure on the economy. It's not the Fed funds rate. It's 10-year treasuries, 20, 30-year treasuries, but specifically 10-year treasuries. And that's really why I feel so obligated to make this video, because, whether or not we avoid a recession, whether or not we go into a recession, I honestly don't have the answer there. But I think the risks psychologically are very high that something could go wrong, right? I don't think we go into a hard recession, but I think if we do, I don't think anyone's prepared for that. Not with stocks where they are, not with, personal balance sheets the way they are. Like, if you have a lot of debt right now and you're watching this video, and there's a chance that rates just stay high for a very long time, right now is your time to save cash, to pay off debt, get your credit cards looking right, okay? Recessions create millionaires if you can take advantage of it. Now, if you're buying NVIDIA at $700 at a $2 trillion market cap, go for it if you want. But if we do go into some kind of environment where the 10-year treasury yields will not come down and they're just staying high, as Jeffrey Gunlock says, that's a risk you cannot afford to make. If you have debt and you are maybe even getting close to retirement. These are risks that are unfortunately too high to ignore. Although I don't exactly think they're likely, it is possible. It's especially with what the current CEO said. balance sheets do not look good on a household by household basis. I'm sure those of you guys watching this video are in a better position. You're invested in stocks, for crying out loud. But I mean, you could make an argument that after taxes run out, most of you guys probably don't even get a tax return. Then maybe the lower end of the consumer is going to be in a little bit worse of a spot. And again, I want to stress the point. Forget about the Fed. Forget about the Fed. If you want stocks to do well, it's all about the economy. Now, earnings have come in good. That's why stocks have done well. If the economy rolls over, earnings will stop coming in so good. And again, that is a risk that unfortunately is too high to ignore. I want to be clear. I don't want to come off too doom and gloomy. Again, I do think odds are we avoid a hard landing. I think odds are the worst case scenario, be it 10-year treasury yields, just continue to rise even when the Fed cuts rates. I don't think all of that is the most likely outcome. I think maybe a 5 to 10% chance of that. 5 to 10% chance, you're essentially talking about what could be a depression. Those risks are too high to ignore. When you look out at the broader markets just arbitrarily, look at the S&P 500. It's not priced as if there is a 5% chance of a depression, of 7+% 10-year treasury yields that will not go down because the world is not buying our treasuries like they were before. Whether it is because the Fed is, printing money like they're drunk, whether, it's for XYZ other reason there would be not to buy 10-year treasury yields, which, I mean, there's a lot of reasons for that. Okay, let's be honest. There's a lot of reasons to buy other assets instead, even Bitcoin, if you are a country looking to put your currency into treasury. So I just think there's not enough people talking about this, and I think these clips bring up some very valid points. Now, one of two things happens, and I want to be clear about this as well. Either we go into a recession, the worst case scenario happens, everything does poorly. In that case, you want to have as much cash as possible. I'm currently raising cash. I got about 5% cash right now. I want to raise that to about 35, maybe even 40% cash. I would not be opposed to that at all, just given where some valuations are. But I'm also not selling anything. Why? Because I own a lot of Tesla, and most of my portfolio is in interest rate sensitive names. I don't want to leave those names because if we avoid a recession, if the Fed does lower rates, what's going to do best? Magnificent 7 might do okay. They're already up 77% in the last year. Equal weighted S&P's up 4%. Russell's up 5%. A fraction of big tech. So what happens? We avoid a recession, rates go lower, cost of capital becomes easier, and Russell 2000 names outperform. So in my opinion, if you really want to put some money to work here, which I always will, say that's a good idea. It's better to be invested than not. It's in your Russell 2000. It's in your beaten down quality names that maybe are having a hard time because capital is pooling into NVIDIA. It's pooling into AI, this bubble. You can also make the argument that next week, NVIDIA reports earnings on Wednesday. They're going to have to give you some stupid number to go higher. And when NVIDIA falls, that could allow hundreds of billions of dollars of capital to disperse into other, areas of our markets. Keep in mind, when a stock goes up and down, the money just moves around, right? When a stock goes down, value isn't actually lost out of the system. It's taken from one asset and potentially put into another, whether it's people's bank accounts because they sold the stock or whether it's going into other names. So with all that being said, again, if you want to be invested or you want to keep adding interest rate sensitive, Tesla. That's my game plan. At the bare minimum, raising cash right now is a great idea. Recessions have made, recessions are basically recipes for millionaires or up and coming millionaires. You can't take advantage of that and become very wealthy during a recessionary environment unless you have money to work with. So I think that is not a bad idea right now as well, but definitely taking some profits in NVIDIA, in Microsoft, some of your stretched Magnificent 7 stocks. definitely not a terrible idea right now as well. Let me know what you think about this information down below in the comment section. Hit that like button and subscribe to the channel. If you guys want to come join the private coveted trading community, check out that link down below in the description of this video. You guys have a great rest of your day, and I will see you in the next one.